Folks, welcome to the Heritage Wealth Planning YouTube channel. I'm actually out here. I'm doing some charcoal grill on my gas grill for some brisket. And while I'm sitting here just enjoying the day, it's literally the clouds are, sun's going behind the clouds. I want to share with you why you should do a Roth 401k. And I find this is a question I get all the time. I'm actually going to get a little bit more detailed with the numbers in a different episode for sure. I'll bust out some spreadsheets and whatnot, but just I'm sitting there with that sucker going. I'm using charcoal in there, and I certainly you can see I'm sweating a little bit, and I got some wood chips in there too to hopefully start smoking. It's not smoking now because, man, I love some brisket, especially on my birthday, which was 2 days ago, but we're celebrating today. So all right, so if you have, apparently, I was watching my man Dustin Tibbetts over at Jazz Wealth actually today, and he found some research that said about 40 or 70% of employer-sponsored plans now offer a Roth 401k component. And I don't know if that's just private companies. I know the TSP, Thrift Savings Plan, there's a Roth component there too. So for government workers, that's absolutely one you have available to you. But that's a pretty significant amount. So if 2/3 or more, almost 3/4 of the people have a Roth 401k component, Roth TSP, probably a 403b might be a little bit less available, I'd imagine, but I don't know that for sure. You want to take advantage of it. Everybody should take advantage of it. And I'm going to tell you why. And I thought Dustin did a great job on his explanation in terms of the different concepts of the Roth 401k versus the traditional. Jazz Wealth, that's where you want to go to if you want to find more about Dustin. I did an interview with him on my podcast. So, before I forget, if you like what you've seen here, don't forget to subscribe. I think if it's live, I got to go that way down below there. And if you do subscribe, hit the notification button to be notified of future content. Because as you know, we do about 5, 6. I'm really starting to get about a video a day now. And there's just tons to talk about. So you want to be kept in the loop of all that. All right. So let's explain what a Roth 401k is. Oh, actually, let me back up a bit. Let me explain what a 401k is. So a 401k is what's called a qualified retirement plan. All right, so your employer sets up a plan that you have the ability to defer some of your salary into the plan and not pay tax on that salary until you pull money out of the plan. All right, so it falls under the ERISA statute. Now, IRAs do not fall under ERISA, so IRAs have a little bit more leniency in how they're governed. But ERISA, the Employee Retirement Income Security Act or something like that of 1974 governs 401ks. So your employer sets up this plan, and you have the ability as the employee to put your own deferrals in there. Okay, so you can put, I think it's $18,500. I think is the max this year. $23,000 if you're over 50, something like that. So you can defer a heck of a lot of money into that plan, more so certainly than you could if you're in an IRA, which you can only do $5,500. So if you're married, you can do $23,000 if you're over 50, and your husband can do as well. That's more than almost $50,000 of tax deferral right there. And so simply what that means is if you have $100,000 of gross income and you're putting $50,000 into your 401k, again, it's got to be two people, you and your spouse, you reduced your gross income by $50,000. And again, these numbers are off a little bit, just get the issue. So now you had 100,000 gross, you put your 401k contributions in, you have 50,000 before your standard deduction. If you're under 65 and you're married filing jointly, your standard deduction is $24,000. So you're only paying tax on paying tax on $26,000. And if you're and I see a big old bug flying around over there. So if you're married filing jointly, you're in that's right in the 12% tax bracket. That's is it 10, 12? I can't remember, but actually I forgot what that is. Is that in a 10% tax bracket? I don't know, but it's in the low tax bracket either way. So you're paying, $2,500 in taxes or something like that. Not too shabby. Now, the problem is you're only deferring the tax till later on. And that's why, while that sounds pretty good, I'm going to tell you why you should do the Roth instead. So just remember, $100,000, you put $50,000 into your 401ks, you have $50,000 before your standard deduction. All right. So that's your taxable, your gross income before your standard deduction. You subtract out your standard deduction of $24,000, and your taxable income in that case is $26,000. All right, so now that is how you can contribute to your 401k. It has nothing to do with your employer whatsoever. A lot of employers don't even match it. So the only way you can contribute is via your salary deferrals. That's the only way to do it, because some employers don't even have a match. No, other employers, most of the big companies, like my old firm was fantastic, USAA, they had a pretty significant match. I think they matched dollar for dollar on the first 8% you contributed. So if you contributed I don't know, if you had a 100,000 salary and you contributed $8,000, you'd have 16,000 in your account at the year end because you put your 8,000 in, they put their 8,000 in. That's fantastic. And after 2 years, you're fully vested. It's a wonderful opportunity for sure to really get your 401k built up fast. Now, both of those are tax deferred. All right. So at the end of the day, you say, hey, I'm taking my $16,000 out. You're going to have to pay income tax on it. There's just no getting around that. Now, there's a third component to a 401k, what's called a profit sharing. Now, certainly a lot of companies do not offer this. USA did, again, which is fantastic too. So USA, if you're looking for a job, is a wonderful place to really build up your retirement account. So what they do is they'd have your deferrals, 8%, your company's deferrals, match, 8%, and then profit sharing, whatever the corporation felt was a profit. Could be 10%, 12, whatever it was. Now, at the end of the day, you have some limits on how much can actually be in that 401k. I think it's 48,000, 52,000, something like that. By law, under ERISA, only a certain amount of money can actually make its way to your 401k. And if there's too much going in, they make you pull it out. So there's only a certain amount of money that can go in. So if you're deferring 20%, $20,000, and they're matching $20,000, that's $40,000. The max that profit sharing could be for you would be $10,000 or whatever it is. And so that's still pretty good money. Don't get me wrong, but that's how that works. All right. So that's the three components of a 401k. You got your employee deferrals, your employer match, not or, employer match, and then you got on top of that, you got the profit sharing component. All right. So, but now what happens? The only thing you're in control of is employee deferrals. So you get to choose if you want to put your money in the Roth component of it. And if Dustin is correct, and he's citing T. Rowe Price, so I assume they are, 70% of plans, again, I think this is private plans, have a Roth 401k component to it. So if you want to put your own money into it, say that $20,000 into your Roth 401k, as opposed to the traditional side of it, what happens is that you do not get tax deferral on that. So going back to the example we're using, husband and wife, each putting $25,000 into their deferrals. They're still deferring the money. They're not spending it, but they're deferring it to the Roth 401k. So now their $100,000 is not reduced by the $50,000. Why? Because a Roth is after tax. You don't get that deduction or the reduction in your income. So basically, I'm putting $25,000. My wife's putting $25,000 in. We got $100,000 of income between us. We have $100,000 of income before our standard deduction kicks in. That's our AGI. Our taxable income, $100,000 minus $24,000 in that case would be $76,000. And there's a difference. $76,000 is the top end of the 12% tax bracket. $24,000, I think is what it was, or $26,000 is either at the bottom end of the, I think it's actually in the middle of the 10% bracket. Yeah, it is. So you can see the difference. $74,000 is our taxable income at 12%, whatever that is, versus $26,000 at 10%. That's the difference right there. Now, so a lot of people say, I don't want to pay that extra, couple $1,000 in taxes. Again, another bug flying around there. So I'm going to defer and take the deduction today as opposed to later on with a Roth IRA. Or I'm just looking at this bug right there, it's scaring me. So I'm going to defer taking the income, write it off my income tax right now and get that extra couple $1,000 tax break today, and I'll worry about the taxes later. The insinuation is, or assumption I should say, is that they think that they're going to be in a higher tax or a lower tax bracket when they retire. They say, oh, well, I'm working now, making $100,000, my wife and I, and because of that, when we retire, all we're going to have is Social Security and some distributions from our IRA account, so we're going to be in a lower tax bracket. And that could be true. In some degree, it might. My inclination is more often than not, it's not. And I think people miss this up badly, actually. And why do I say that? And how do I know that? I can prove it to you simply. Because husband and wife, Josh and Charlotte, when I die, is now just Charlotte. She goes from a married filing jointly tax-paying unit to a single tax-paying unit. She reduces one standard deduction. Her tax brackets go up. The amount of money that's subject to income tax and Social Security goes up as well. And so immediately right there alone, she's in a much higher tax burden than she would be when she and I married together, even if we had more income. I get in a lot of this in my book that's coming out in Roth IRAs. But that's why I think a lot of people miss the boat here. They think, oh, we're making $100,000 now. We're not going to make $100,000 in retirement. Thus, let's go ahead and take the deduction, and we can squirrel the extra tax away in spending money, or we'll worry about paying tax on it later when our income bracket is way lower. And again, there is some validity to that, but at the end of the day, I don't think it happens nearly to the extent what other people think. So what happens now with a Roth 401k, because you don't get a tax break today, you don't ever pay taxes on it again. And so you take that money when you leave your employer and you roll that sucker over to a Roth IRA, because a Roth IRA, there are no required distributions, where a Roth 401k, there are. So you want to move your Roth 401k over to your Roth IRA when you leave your employer. And just going back to what Dustin said, you're going to have two accounts. The employer contributions are always going into the tax deferred bucket, always. All right. Employer contributions, be it the profit sharing and or the company match, are always going into the tax deferred bucket. So that is account A. That's your deferred bucket. What I advocate is you have a tax-free bucket as a way of arbitrage. You're essentially hedging against future tax increases or even decreases, frankly. And what happens is now you have a little bit of each. You're going to have probably more so in the, well, not necessarily, but let's just say you have 50-50. You have $50,000 in the 401k, the traditional, and $50,000 in the Roth 401k. What a wonderful tax hedge. So now when it comes time to retire, depending on your tax bracket, you can say, where do I want to pull the money from? You can pull it from your Roth IRA. If your tax bracket is higher for whatever reason at that point, maybe you had a big capital gain, you sold investment property for a huge amount of money and you want to take money out, but you don't want to get hammered on taxes, pull it from your Roth. On the other hand, maybe you don't have any income whatsoever. Like I'm working with a lady right now, got no income coming in. So it's perfect time to start pulling from a regular IRA. And that would be the company match and their company contributions. So it's a wonderful strategy. You got a tax hedge. You're saying at the end of the day, I got this bucket of money for taxes, that bucket of money for taxes. We'll see what the situation dictates as I need the cash. And only through a Roth IRA can you have that. You can't have it with a traditional because you are forced to take money out when you hit 7.5, regardless if you need it or not. You are, and you're forced to pay taxes on the very first penny. Now, if you're in a huge tax bracket, that might make sense to avoid paying taxes to get the tax deduction today, because you might be in a lower tax bracket in the future. But you got to look at RMDs, my friends, required distributions. As you get older, they get larger and larger and larger. And then you die, they get even bigger for your surviving spouse because she has more and more taxable income, or he. And that's what I'm trying to say. To have the hedge, if nothing else, a tax arbitrage hedge between a Roth 401k and a traditional 401k, it just gives you more nimbleness to be able to choose your own tax mechanism in the future, which you won't have if you just throw everything in the traditional. So remember, the difference is you got $100,000 of income, you're paying taxes on $76,000. It's 12%. You got $100,000 of income in the traditional, you're paying tax on $24,000 or $26,000. So that difference in taxation is what you got to pony up today if you go the Roth IRA route. And you should, without question, in my opinion, simply because the Roth IRAs, the advantages are just mind-numbing, which I'll share with you in my book, which I'm just about done. But you absolutely should do the Roth 401k if you have it, without question. You will not get a tax deduction today. You don't get access to the money. You're still deferring it. But at the end of the day, the money is growing tax-free. If you don't need it when you retire, you can roll that over to an IRA. There's a Roth IRA. There's no required minimum distributions. With a traditional 401k going into a regular IRA, there are RMDs, required distributions, which you have to pull the money out. And a lot of times that'll be at the most inopportune time for you as well. So anyway, Roth 401k, if your employer provides that option, and I think they do because 70% apparently do, man, do it. Your circumstance, extenuating circumstance dictates, situation dictates, like we used to say in the Army, but just by and large, the default should be for the Roth 401k for your contributions, and your employer contributions will always go in the traditional. Hey, hope this helps you. If you have any questions, by all means, comment down below. And sorry about the sweat, man. It's just the sun's coming out. Oh man, got my brisket going over there. It's a good day to live in America. Comment down below, or don't forget to subscribe down below, whichever side it is. Don't forget to comment. Thumbs up, always helpful as well. And if you do subscribe, hit the notification bell to be notified of future content. We'll see you next time. Oh, I was going to say too, if you want, I do this email list. And if you want to get on the email list, just go to the website at heritagewealthplanning.com and sign up. I try to send an email about 3 times a week. So I do a video about once a day, try doing an email about 3 times a week. Sometimes the emails, because I can, a little bit different than what I talk about here on the YouTube channel. Sometimes not, sometimes they are. So if you want to be notified of emails, go ahead and sign up for that too. heritagewealthplanning.com. See you next time. Thanks, guys. I'm gonna hit end right there. Crack out.